Good afternoon. It is a pleasure to be here today, and many thanks to Delphi for the kind invitation. Congratulations also to the whole team for an exceptional digital version of the forum, which I think this year is also probably a little bit more democratic, as anyone can attend the very interesting discussions. I think the forum is becoming more and more international, and maybe this year we have helped a little bit with this. We have many people from all over Europe attending our panel today. It is, of course, also a great pleasure to have a fantastic panel with me, exceptional investors with a tremendous track record in sustainability. A quick introduction, Mr. Jacco Minnaar, joining us from the Netherlands, Chair of the Management Board of Triodos Investment Management, a Netherlands-based multi-billion global asset manager with a very long history, a 30-year track record in sustainable investment. Mr. Antonis Schwarz, joining us from Munich, an impact investor, an activist, a philanthropist, a person with an extensive knowledge of the European impact investing landscape. And Mrs. Tina Mavraki, joining us from London, a commodities and finance senior executive with global experience, managing director of Ingenios Limited, and non-executive board director of MYTILINEOS. So welcome all. Thank you very much for being with us here today. So today we will be discussing sustainability and impact investing in the post-Covid-19 era. We feel interest in sustainability has increased amid the crisis, maybe also because investors are reassessing the environmental and social profiles of their portfolios. We also expect high growth in the years to come. But before we start, a short definition of what impact investing is. So with impact investing, we are referring to the methodology that is targeting balanced risk-return profiles while maximizing the environmental and social footprint of an investment. Our compass is the United Nations Sustainable Development Goals, and our vision is a more resilient and circular economy. And I think the pandemic has, to a certain degree, highlighted exactly this, that our economy is not resilient. I feel we need, for example, going forward, more robust supply chains. We also probably need to rethink our money's investment purpose so that we can change the way we invest. And Jacco is going to tell us a little bit more about the opportunity, about the potential. Jacco, welcome. Before COVID-19, we read in an IFC report that the appetite for impact investing could total 25 trillion US dollars. This is a tremendous amount. Do you agree with this prognosis? And is this going to change with the pandemic? Is it going to be reduced, or do you actually expect it to accelerate? And some people say that sustainable investments might be the new normal going forward. Tell us what you think.
Yeah, thank you very much for having me, Kostis. And let me first answer your question directly. I think yes, ESG and impact investing will accelerate. But let me elaborate a little bit more. What the IFC says is basically that about 10% of the total assets, which then will total some 26 trillion US dollar, is needed for the SDGs, is needed for impact investment. Now, there is a supply and a demand side to that. So this is the need, and we still really all have to make that happen. But the pandemic itself, it has basically hit us all. It has hit all people, all economies globally. It's also a different type of crisis compared to the previous one. And we do see that this has people, politicians, and also investors really thinking. So this is a moment of change. Now, if we look where pre-corona, where investors were, most of the money was still unscreened. And then we had some light ESG integration. And then the amount in actual impact investment is relatively small, less than 1% of the total. But there is very positive news. And the positive news is that 94% of ESG and impact investment funds have outperformed mainstream indices. The positive news is that if you look in Europe, that ESG and impact investment have seen in the last weeks since the crisis started 33 billion inflow, even though mainstream markets saw 163 billion outflow. These are Morningstar figures. So we do see that there is more acceleration perhaps, and certainly not a slowdown. And this is also driven by the fact that asset owners are really catching on. 95% of them says they do some form of integration in some of their portfolios. 57% say that they can envision that in a relatively short time, they will only allocate to investors that at least have some ESG formats. So it will be hard work, but it sure is going to accelerate, Kostis.
For this, and you answered already my second question to a certain part, that on the one side, the United Nations is expecting a drop in direct investments in general. So from what I understand, you feel that a certain percentage of this drop will not potentially going to affect sustainability. But I know that you have a lot of strategies. You have different strategies with different investment products. So you probably are the best person to answer the question, what industries you feel are going to be affected by this drop? What segments, what industries, or what themes?
Yeah, that's a very broad question, so a bit tough. But the first thing is, COVID is hitting very broadly. So it is not just one sector. There's only a couple of sectors that are actually exempt or that are maybe benefiting from this. I'm perhaps most worried about emerging markets because in terms of their healthcare systems, in terms of their ability of governments to actually invest now, they are probably most vulnerable. And what we have seen happening is that there is on the one hand the flight to safety into the dollar, into the euro. So investors are to some extent leaving emerging markets, and FDI may also be hit. So there may be a bit of a drop short term, and I think some blended finance may be part of the solution to that. So governments and private sector impact investors teaming up. But longer term, I don't see this problem. I don't see that impact investors, even in the short term, will go out, simply because if you want to realize the SDGs, most of the work has to be done in emerging markets. Simply also because still, if we look at the new funds that are being launched, we still see quite a big tilt towards emerging markets. So that's a good thing. But underlying all that is that today's crisis in those countries and the lack of services that we have is really the long-term growth opportunity.
Thank you for this, Jacco. And you mentioned private investors. Antonis, we know that the majority of the millennials and the next generation family members are very fond of sustainable strategies. You know this firsthand. What do you think are the reasons behind this? And will this intensify with COVID? You can also tell us a little bit how this specific group of investors has responded to the short-term challenges that were created.
Yeah, I can say a bit about it, and probably others also in the panel can. Yeah, please, Antonis.
Yeah. So yeah, I mean, what you mentioned, the millennials, there are a lot of studies that have shown that they place a lot of emphasis on environmental issues, and maybe quite rightly so, because frankly, my generation doesn't want to willingly participate in the destruction of our ecosystems and to the growing inequalities within our society. Quite on the contrary, the young investors like myself, they want to see their assets go to work in a way that represent their values. But again, impact investing tries to fix in some way the deficiencies of classic portfolio theory, which traditionally has underestimated environmental, social, and government factors in the investment process. So in a way, ESG investing and impact investing represents the logical evolution of investing, and could be called a more holistic and realistic type of investing. So this will certainly continue, not least because we've got very serious issues with climate change and also creating more inclusive growth.
And Antonis, I think the main difference between a green investment, as a lot of people are using the term nowadays, and impact investments is actually the measurement of these social and environmental metrics. Do you think this is now becoming a little bit more important?
Absolutely. I mean, what I've seen personally is that companies report differently. For example, and the impact of COVID, obviously the number of cases inside their company, the number of layoffs they had to make, if they had to make any. And so I think it had an effect in this form. But going forward, I think it will create even greater impetus for companies to incorporate ESG factors into strategic decisions. And it will also have an effect on the impact measurement. And I think what also will be an effect, what you mentioned, is that the localized supply chains will play a greater role, because obviously with Corona, we've seen that companies that have more localized supply chains are more resilient to external shocks.
Absolutely. And Tina, we mentioned before, Jacco mentioned that already, the inflow that is coming direction sustainable investments. And do you think that this might also be linked to a change in the perception of risk going forward? Do you think that maybe we can also connect it with performance, which everybody is interested in? Do you think that these kind of strategies will outperform in the new landscape?
Hello, everyone. First of all, definitely, I think sustainability has added many more parameters in risk evaluation. So what I think is important to me, at least, is that these risk parameters are specific, clear, and measurable. Let me just provide a case study of risk evaluation in supply chain, since it was mentioned previously, from my portfolio management experience. So we provided debt to a fruit juice producer in South Africa and Brazil, medium-sized company with global off-takers. So we enhanced the IRIS impact taxonomy to track 105 impact assessment factors. And this enabled us to demonstrate impact tangibly across 6 different metrics. And with thorough risk work, we managed to get a major development finance institution to co-invest with us, something that was mentioned before about blended financing. Now, sustainability risk assessment varies widely in supply chain businesses alone. And I have personally been tracking a significant pipeline of debt investments. And this gives me every confidence that the 300 billion that you mentioned can be absorbed successfully. The key, again, specific, clear, and measurable risk parameters to enable thorough investment evaluation. Now, sustainable strategies have already been outperforming prior to the COVID-19 outbreak. And this is definitely going to accelerate going forward. Take governance, for instance, out of the ESG acronym. There are numerous studies out there that measure a stock price premium of up to 22% for listed companies with good governance. Anything from higher internal risk controls, more reporting obligations, they just build confidence in the investment outlook. And with COVID-19, financial authorities have already requested further disclosures. Investors have been monitoring closely performance and growth. Governance aspects, companies have been going public, linking their corporate values to crisis response practices. So definitely, better governance alone will continue to boost investment performance.
So it's not anymore that long term, because we as the impact investment community are always long term, of course, and we feel that the extra returns are going to probably be seen in on the mid or in the long term. So Tina, you're saying that we're seeing that probably already with some premium, and I think it's interesting to see how this, maybe we can also close with this, how this will affect Greece, or how is Greece going to be affected by the whole post-COVID stimuli from the European Union that we're going to receive. Because I do feel that the current administration has indicated at least their dedication to a transition to a more greener economy, which is very positive and we very much hope for. But at what degree do you think this packages, these support programs will boost the transition to sustainability, especially in the areas such as renewable energy, for example?
Sure. Well, the renewable energy sector has definitely displayed great resilience throughout COVID-19. There are currently, just indicatively speaking, 30 gigawatts of renewable applications in Greece alone. And we see both established, new players active in the market, and they all possess very solid know-how. You have the international community that's looking at renewables in Greece very closely, both industrial and financial players are involved. So green opportunities will manage to absorb any portion of that stimulus package very successfully. From my perspective, sitting on the board of MYTILINEOS SA, the organization has strong green commitments. Just a few highlights from our energy activities. We have a renewable portfolio that stands at 211 megawatts. You have 55 megawatts that are under construction at the moment, and you have a pipeline of 600 megawatts. Additionally to that, you have the company's goal to support aluminium energy production solely through renewables by 2030, in 9 years' time. You have also the 826 megawatt gas-fired CCGT power plant that is underway. That is 300 million euros of capital expenditure. More generally speaking, the role of gas in transition energy is very clear. And really, it is especially topical given the pressure from the European Union to retire highly polluting energy production fleet. The solar sector itself offers very attractive yields given how prices have come off. Offshore wind activity is also ramping up. You have the storage front where you see very interesting hybrid renewable applications in hydro plants. Similarly, in combining renewables with hydrogen technology, which are currently at feasibility study stage. You have grid upgrades with new substations coming on stream. You have island interconnectivity with Crete getting started, and both clearly have very green implications. So as the renewable legal framework continues to advance, I'm sure we will manage to achieve a smoother and greener solution in energy supply.
Legal framework is a big word, of course, and generally the conditions as well, because I think the momentum is great, but there are also some difficulties, especially for all of us as foreign investors, to get to Greece. And I want a half a minute comment from Antonis on this, who has some experience with investments in Greece, and another half a minute comment from Jacco on the ideas about this region, maybe Southeastern Europe in general. And with these two comments, we're also going to close. Antoni?
So comment on the renewable energy sector, or what exactly? I didn't understand.
And on your experience in terms of difficulties with doing investments in Greece so far, half a minute, a very quick comment. I think that would be useful.
Yeah, sure. I mean, traditionally Greece has been a nightmare what concerns bureaucracy, and I mean, I can only speak from my own experiences. I still think there's quite some way to go in reducing red tape, but not only from the government side, but also, for example, Greek banks. I think the Greek banks need to do better in helping investors, create bank accounts and basically set up their legal entities in Greece. So yeah, I mean, from my experience, the paperwork needs to be reduced. A good measurement is how many stamps you need. In Greece, we're still obsessed with stamps. Like, I don't know any country that uses so many stamps like Greece, personally, in the European Union. So these are just a couple of things. So, if you want to have investors be happy with their investments, reduce the paperwork, reduce the stamps, and reduce the time you need to go to various agencies.
And Jacco, if those difficulties will be reduced, as Antonis has mentioned, the stamps, do you think as a global investor you would like to include Greece as well? I mean, you're already active in Southern Eastern Europe, and I know that. Maybe the final comment, and then we can close.
For sure, Kostis. I've only been to Greece a couple of times, but I'd love to go more. So I would say for sure. But on this panel, I don't want to portray myself as an expert on Greece. But I think what we do see in Europe in general is that things are changing on different levels. On a political level, from neoliberalism, we will see a bigger role of governments going forward. And then with investors also moving in that direction of looking more at ESG and impact, also based on the long-term performance and the diversification it has to some of the investments that they have, I can see the two sort of moving in the same direction. And that will really help to accelerate this trend of impact investing, Kostis.
Fantastic. Thank you all so much. This is it from us. Thank you all for participating in this panel, and of course our viewers for attending. Thank you very much.
Thank you.
Thank you.
Thank you.